Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey Fleck here, your host for the first half of this show. In the back half, Chad will be back with us as we're going to focus back half of the show more on investing, specifically in resource stocks, mostly the metals stocks. First half of the show, we're going to be talking markets. Even though the markets have been a bit boring, just as a reminder, please go back through our website, kereport.com, or through your podcast player, the KE Report. That's all you have to search, as well as our YouTube page to listen to all our daily editorials and company updates. We really appreciate hearing all of your feedback from our interviews, especially the company ones, because there's just a lot more action that's going on with a lot of the companies we follow this year. To kick off the show, I'm chatting with Dana Lyons. Dana is fund manager and editor of the Lionshare Pro website. Dana, as we always do, we'll look across the spectrum within the markets to see what's outperforming and what's underperforming. Right now, as I said, these markets have been a little boring. They haven't been dropping very much. They also haven't been popping very much. That being said, the S&P did just hit another all-time high this week, but really kind of a marginal high, and then we saw weakness on the back of that high being hit the very next day. One thing we can say for certain is that this market is not at all being led by the Mag 7 right now. Maybe that's the problem with the markets being boring. But Dana, what's your takeaway from really how the markets right now are more or less just treading water sideways?
Yeah, that's a good point, Corey. We've been seeing kind of a bifurcated market, really, for most of this year after markets pretty much peaked in December, had a sell-off, and then we saw a better recovery in the large cap growth stocks, which have continued to pretty much be the relative strength leaders in the market. Most of the large cap averages have been back up, testing or approaching and consolidating near all-time highs over the last month or so. Even as, the broader market, beginning with that breadth sell-off in early December, which really gave our models a heads up about potential deterioration in the broad market coming. And since then, we've seen really the broad market and the breadth continue to tail off. We did see a bounce back into January into lower highs. The broad market, small caps, mid caps, equal weight stuff really formed lower highs, even as the large caps, like I said, went up and at least tested all-time highs. So you continue to see, from a relative perspective, the large cap growth continued to lead the broader market, but not making much progress at all, like you mentioned, more going sideways and being resilient, but not selling off. But as far as our models are concerned, as far as our allocation is concerned, we'd feel much more comfortable and have much more ammunition to get more aggressive if we did see the broader market begin to bounce back more. If we saw breadth begin to bounce back more, and the internals start to recover more strongly and really get the support of the broad market turned back higher, that would give us a little bit more, like I said, fodder to get more aggressive. And I think that point will come after we get through a little bit of a dicey short-term environment right now.
Man, there's a lot of noise out there, especially on the political front, that I'm sure is holding these markets back a little bit and making investors kind of figure out what the lay of the land is. But let's get your outlook for the rest of this year. Usually we talk more short-term trading strategies, but when you and I were chatting off mic, you were talking about your models and your longer-term, more or less, thesis for this year. Now, these things don't always pan out the way that everyone outlines them, but look, there is still, I think, a balance contingent out there saying these markets are due for a major correction, and then another contingent saying, look, everything seems to be going pretty well in the U.S. These markets could keep on moving higher. What's your outlook throughout the rest of this year?
Yeah, it's a good point. And, being in the markets for many decades, you do get a sense for the overall, the conditions in the overall market and what types of moves or scenarios are most likely. The good thing is, from our perspective, is having an objective quantitative models that really direct our decision making at the end of the day. So even if our overall thesis is wrong, as long as our models are correct and keep us positioned correctly, then I don't mind being wrong with this thesis because I got that backup in my pocket. But as you mentioned, looking at different durations, we do have a setup for potential. If you go near term, potential some weakness here, especially throughout the last half of February, typically weaker seasonality. We do see the potential for following that a perhaps another run, another strong run, maybe a blow off type move to the upside. And that sucks investors back in, really it gets sentiment extremely bullish again before the ultimate rug is pulled out from underneath them. Because, like you mentioned, and we've talked about in past shows, from a longer term perspective, looking at what we call those long term backdrop or background indicators, things like percentage of assets invested in stocks. You look at stock valuations, you look at stock market cap versus the economy. Everything is at historic highs, historically excessive levels. So we are building up to potential major top and beginning of a very long and very difficult period for investors. But like you mentioned, it's all a matter of timing. Those long term indicators are not good timing indicators. They just give you a degree of risk in the market for when when the rug does get pulled out from under it. And like I said, the risk is basically at an all-time high from a longer term perspective. But as I mentioned, as long as the data, as long as the momentum and the breadth continues to move higher, as long as it does, we could have significant gains, significant profit opportunities to the upside before the ultimate top does occur. So that's our, as you said, thesis generally looking out for this year. But we do think this year, 2025, has the opportunity, the possibility of being like a major type of a juncture year in the markets.
So what could be the leading sectors then this year? Do your models give you any insights on what could carry these markets?
When we're looking at investment selection or specific sectors, we do have relative strength models that basically measure the most important factor is really risk adjusted return and the amount of return and consistency in return versus typically the risk inherent or volatility inherent in those sectors. And right now, we're continuing to see that large cap growth area of the market lead the way. And we'll continue to, even if we do see some short-term choppiness here, we're happy to dip our toes into those types of areas as they pull back to good entry points. But we will continue to follow our quantitative models as far as relative strength and those areas that are best set up for near-term to intermediate-term upside. And that's basically what's leading right now. And various areas in the technology sector, various financial subsectors leading the way. And then you have some offshoots like, aerospace and defense has been really good. Some of the foreign markets are re-emerging here, especially on a currency hedge basis. So we are looking at those on a pullback, hedged in foreign currencies as we're seeing some of those foreign markets break out, especially over in Europe, which, from a subjective notion, you kind of scratch your head and be, why is Europe breaking out? But from a profit perspective, we don't really care about the why as long as it is. But again, it's best played on a currency hedge perspective, and that's what we continue to do there.
Dan, how about interest rate sensitive sectors? Rates are remaining generally elevated, 10-year right around that 4.5% level. Fact of the matter is, we don't have the outlook of getting any rate cuts anytime soon, this year at least. So the expectations are rates are going to remain at generally elevated. Are interest rate sensitive sectors then being hit?
Yeah, from a short-term perspective, it doesn't look like rate cuts are on the horizon, at least not to the point, not to the extent that they were, if you looked 4 or 5 months ago. However, it doesn't really speak to the prospects for longer term rates. That'll be guided by, other factors beyond the Fed's control. So right now we're seeing interest rates kind of move sideways, similar to what we're seeing in the equity market. We're not seeing them flying higher. Basically, it's a coin flip right now as far as the 10-year and the 30-year. But I don't know. We'll see. We'll see. Inflationary forces look to be building back up again, which could be damaging, obviously, to bond markets. At the same time, if we see the Doge factor continuing to shore up potential finances in the U.S. government, that could have a positive effect on fixed income. So there are a lot of factors, a lot of market forces that'll affect those longer term rates that beyond just the control or just purview of the Federal Reserve. So that's always interesting. As you know, I think in the long term, we did form a long term low in interest rates in 2020. And by and large, they should be rising for the next decade or even further. But in the interim, it's not going to be straight up. So you could have big swings. I could envision, one more big pullback in bond yields before that next major low. But we'll continue to monitor that closely. And again, it's important to read the market data, not just listen to the Fed when we're considering longer term interest rates.
Yeah, very true, very good point. But hey, a lot of people do still always hang on what the Fed has to say, but they have outlined a more cautious approach throughout this year. What about dividend sectors then? Dana, are you seeing any opportunities in some of these sectors that can pay investors back, keep up with these generally higher rates?
Yeah, in fact, we've been involved in a couple dividend plays over the course of really the last year or so, both ends of the spectrum, both smaller cap as well as some larger cap names. Small to mid cap ETF, ticker symbol is SDVY, did top out in December along with, the rest of the broad market, but has hung in there pretty well. I do like the looks of that. It's basically pulling back just from all-time highs from December, unlike some of the other broad markets that couldn't surpass those 2022 highs. So this one was able to hit new highs and consolidating right now. I like the prospects for that. Another name, a dividend name, would be a technology dividend ETF. TDIV would be the ticker symbol, which is trading right at all-time highs right now, which we continue to like. It's consolidated for the last 6 months or so, and I think building up for the potential for another breakout, another what could be substantial up leg there. So there, we do like the prospects for some of these dividend plays. So that would be just two of them.
All right, Dana, I also want to talk global markets. Then you said how Europe is doing well, and the one thing I keep on hearing is just how dominant the U.S. markets have been, how they account for pretty much the value of all the global markets combined. Also just relates to how well these companies in the U.S. have done, which are also global companies. So is there an opportunity here for global markets to play catch up, especially as you said, it's also a currency play, so maybe a weakening dollar tied in with that?
Yeah, for sure. We've seen obviously dominance by the U.S. for a long time. At some point, some of the rest of the world should play catch up. Europe, for example, hasn't gone really anywhere for decades. And if you look fundamentally, there's not really a case to be made for Europe going anywhere, especially relative to the US. But maybe it's kind of that submerged balloon type theory. It's been held down for so long. Maybe it's just due, but we'll play it, quantitatively and objectively and let prices dictate our moves. But right now, we've seen some breakouts in several of the European countries, as well as some of the broad European indices themselves, which have broken out to all-time highs. And again, that's priced in, for example, the euro. So from our perspective, we want to continue to play those foreign markets in currency hedge terms. In Europe, it'd be DBEZ would be one particular ETF that is currency that is hedged against the euro. You have a couple other broader type international plays in the EFA that are also hedged, currency hedged, that are also breaking out to all-time highs, which would be great buys on pullbacks towards those breakout areas. So yes, you're seeing some moves in some global areas that have been relatively dormant for a long time that are now finally making the moves. But again, it makes all the difference in the world in what currency you're valuing or sizing those gains in. So I would continue to play that in currency hedging against those foreign currencies as opposed to in U.S. dollar terms, which most of the U.S. international equity ETFs are priced in dollars. So you look at those charts, and certainly most of them are well below all-time highs.
Yeah, that's the thing. Maybe a catch-up trade globally too. Let's also touch on the gold sector. More just on the gold stocks though. I want to get your thoughts on something like GDX, the gold miners ETF. You know how much we like to quickly cover that within our interviews. And look, that sector has been a complete outperformer this year, up over 20%. Took a little breather this week, I guess, but still strong to end the week. So Dana, what's your outlook? How much higher could something like GDX go?
Yeah, and we've talked about in past shows, it certainly has been an outperformer this year, but you look at what had happened in the fourth quarter when the miner stocks really got decimated. So we're not even back to those former highs. If you talk about GDX, GDXJ, especially the silver miners and the copper miners, which are even more egregious underperformers relative to those highs from last fall. So we do have positions in all of them. We have been trimming over the last week or so into these rallies to lower highs. I'd rather see, less resistance above, meaning a clearer path, meaning, not recent higher highs to contend with if I'm going to be a little bit more aggressive in those areas. So, for example, you look at the price of gold itself, rather be more aggressive, even though it's run so much at all-time highs. I'd rather be more aggressive in something that doesn't have a series of higher highs to kind of break through. It's more clear sailing. Again, not that I'm advocating going out and chasing the price of gold at these levels, but I'd like to see a little bit more evidence as far as GDX is concerned, breaking through those highs that we've seen. Really going back to the beginning of last decade, GDX was particularly around that 45, 46 level. We can get a breakout above there. Then that opens up a little bit more, upside as far as just speaking technically and supply and demand wide. So it's been a nice run, like you said, year to date, but running into some resistance here and lower highs. So we've been trimming into this move. Not that we wouldn't add back, but again, we'd like to see a little bit more constructive progress technically before we get more aggressive there again.
So, Dana, you mentioned copper and silver miners kind of lagging the move that we've seen in the gold stocks. Is there a catch-up trade there? Does gold stocks need to keep on outperforming to pull those higher?
It remains to be seen. I mean, I'm just looking technically. The moves have tracked each other. It's not like, silver miners and copper miners haven't bounced since the beginning of the year. They bounced along with gold miners. They just haven't bounced as much, and they're well off of the prior peak. So I would say the momentum there in those sectors than in the gold miners. So I really tend to avoid those sectors more so than even the gold miners. It'd be one thing if those miners hadn't made their moves yet, but they have indeed been bouncing. It's been more of a dead cat bounce more than anything in those sectors. So for me, it doesn't inspire a lot of confidence right now because there is plenty of resistance or plenty of levels that they still need to work through. So I would, continue to prioritize those markets from gold number one, silver number two, and copper number three, or maybe copper, silver, neck and neck here, but still gold is the clear leader as far as the precious metals are concerned.
Okay. Dana, before I get you out of here, you are running an anniversary sale. Just explain to our audience what subscribers of yours get when they sign up for the Lions Share Pro and also what this anniversary sale is all about.
Oh, yeah, sure. Thanks, Corey. So with the lion's share, is basically, I know your listeners, a lot of your listeners are traders. With the lion's share, we basically tell you every day what we're doing, what we're looking at, what the moves we're actually making in our managed accounts, our managed clients. And then the traders, subscribers have to pull the lever themselves. But I know a lot of your listeners are capable traders and like to do it themselves, kind of DIY, but maybe like to get a little bit more guidance as far as what levers to pull. So we're very candid about telling our lion's share subscribers what we're looking at again, and if we do make any moves, we let them know, in a timely fashion, what we're buying, what we're selling, what we're shorting, et cetera, across the gamut in all asset classes. And we are running this week. It's our 8th anniversary. We launched 8 years ago, and when we launched, we had a 33% off deal to launch the product, and we're running that again as we do every year. So this will be our biggest sale of the year, except for potentially Black Friday if we run it. But again, like as we discussed, I think 2025 is going to be a monumental year in the market. So if anyone is interested, this would be a great year to try the product. And of course, this week with the sale, probably a good time to jump in if you are interested. So appreciate that. And always great talking to you, Corey. And you got a great audience out there, and appreciate all the feedback I get from them.
All right, Dana, thank you for always taking time with us and sharing your outlooks for these markets. I find your insights very valuable, especially for traders out there looking to find those sectors that are performing well, that you can make some money in simply trading. Again, Dana Lyons, fund manager and editor of the Lion Share Pro. Please click that link and try out Dana's service. Dana, thanks for your time. Really appreciate your outlook this weekend.
You got it. Always a pleasure, Corey. Thank you.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the KE Report Weekend Show. Now shifting our focus pretty much exclusively to the metals sector as we're chatting with Joe Mazumdar. Joe is the editor of Exploration Insights, very valuable newsletter for all of you looking to invest in individual resource companies, not just precious metals. As you're going to hear, we're going to be talking a fair bit about copper plays in this segment. We will also get to a recap of some of the major minor earnings out there, especially in the gold space, as this was a busy week for a lot of earnings reports for this sector. Joe, welcome back to the show. I know you just got back from a long trip in Africa, visiting a handful of different projects. Take us through your trip here. What did you go see? What were your takeaways of Africa and the investing nature over there?
Right. Thanks, guys. Yeah, it was one of the longer, well, not longer, but it was, getting into 2 weeks because Africa is far. It's like a 9-hour flight to Europe, but then it's like an 11-hour flight from Germany down to Cape Town, where I went to one mining, and also in Indaba, a big conference in Africa. My first trip down there to that conference was 2 years ago. So I went back this year. And yeah, a few of the themes there were about what was happening, and I wrote a piece in the Assay, which is out there on social media, and that about West Africa investability, and that was a topic of interest there. And then also another issue is infrastructure, especially for the more bulk commodities like copper in the south, in the Central African Copper Belt, in other parts of Southern Africa, which tied into my site visits down there.
Well, Joe, let's maybe kick it off with the West Africa gold side of things. When you think about West Africa, there's a lot of different countries. Some are investable, some may not be with the political strife. You think about good jurisdictions like Sierra Leone, Cote d'Ivoire. You've got Ghana as a big producing country, but then there's other countries like Mali and Burkina Faso that have had their challenges. How do you look at investing in gold producers or developers in West Africa?
So the attraction of West Africa is endowment, and it's certainly got that greenstone belts, and also the permittability, the social license to operate, and all that sequencing can be much quicker than other jurisdictions. Getting into production once you find something, so that's obviously an attraction. And metallurgically, most of them are pretty well benign, and there's almost a cut and paste way of building these projects and putting them into production, knowing you don't have much infrastructure. It's usually diesel or heavy fuel oil power generations and mostly gold. And so there's a kind of, I don't know, comfort level in terms of the kind of project you're going to see, the endowment, the buildability of it. But then now we've layered on the security risks and creeping nationalism of countries that you just mentioned, like Mali, Burkina Faso, and Niger. And if you look at gold production, let's say 2023, the biggest gold producer, like I think you mentioned, was Ghana, which when I was with Newmont in the 2000s, we would call that Africa Light, an easy place to work, no big problems. Some of the same infrastructure issues as everybody else, but much more advanced. And then the next biggest producers of gold were Mali and Burkina Faso. So combined, they produce almost as much as Ghana. But now they're becoming problematic in terms of investing in those countries because now they're run by military juntas, civilian like leadership, probably they keep deferring it as these kind of groups do. And it's all been driven by security risks. So you have Islamic terrorism that's coming from the north, the Sahara down through the Sahel region into their countries. They're trying to repel them, using their own means. And then the French, that hasn't worked out, led to the aggression of the military juntas to lead the security fight. But that's becoming more expensive. They're also using some Russian mercenaries like your Wagner group. And the cost of all of this is, basically generating the creeping nationalism of higher rents with higher free carries, up to 35% potentially in Mali, and higher royalties, over 10% in proposed in Mali under the new mining code. And we've seen what's with the detention of the Resolute Mining CEO, an arrest warrant for CEO of Barrick, negotiations where you basically have to pay these guys off to get your stuff into production, which has happened with Allied Gold. Barrick has paid off. Resolute Mining in the end have paid off. Barrick's one of the only holdouts right now. So yeah, in terms of exploration, you can see the direct impact on exploration on Mali and Burkina Faso, as right now, from their 2012 peak of exploration in these countries, they're at about 20% of that peak. And I can't see it getting better in terms of people going there to explore, knowing that the economics are harder with the higher free carry and the royalties, as well as the security risks of operating that mean that, you've got higher costs as well. So yeah, definitely that's an issue in certain parts of West Africa.
Joe, what are some of the good parts of West Africa then? Are there any area plays to be had? Are there any companies that you think are truly just standing out and are still investable?
Okay, so if we break that down, like recently, we saw, the Enchi, which was a new core, they raised, I believe, about 15 million for their project in Ghana. So people are interested, again, endowment, ability to build, blah, 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 in West Africa. And so that money's going to an advanced explorer in Ghana.
That is already PEA stage too, right?
Yeah,
So that is
yeah.
advanced stage.
And so then you have Montage Gold feasibility stage building their project in Cote d'Ivoire. That was funded by private equity, streaming, and also the Lundin Group and Zijin came in. And also the Lundin Group and Zijin came in on that project of Bankan in predictive discovery in Guinea. So I'd say like Ghana's always been good, but I think more people are coming back to Ghana, knowing that these other areas are getting more problematic. In Cote d'Ivoire, Guinea, maybe Senegal and those sort of places. People are willing to go because of all those factors that I talked about before. But also, what's happening potentially is people are taking that money and going to another geologically similar area, but in a different part of the world, which would probably be the Guyana Shield. So some of that money that's interested in those kinds of deposits and greenstone belts are moving towards Guyana. And so there's much more interest in Guyana, in Suriname, and places like that now.
Yeah, Joe, we've heard a lot of those presentations, seen a lot of slide decks where they're making the point that at one point those land masses were combined when they were Pangea, and then they've separated, but the greenstone belts kind of continue into South America. So interesting. Well, Africa is a big continent. As we were talking about, it's just a huge place. You were just there in the central area and southern area looking at copper projects. What can you tell us about boots on the ground observations as far as the copper belts in Africa?
So I was in my first visit before Indaba, and that was to Namibia to check out the Habe deposit that's now been rebranded under Corex Copper and is being run by the same people that sold Asino and then also Ojikoto. So Asino is Twin Hills. That went to a Chinese state-owned enterprise called Yintai, which was closed the latter part of last year. And then Haydon was also the guy who was behind the sale of Ojikoto to B2 Gold. So he's from Namibia. He lives in Cape Town. And so he understands the country. And so they've gone into the Habe deposit, which is a big, low grade, open pit, amenable copper deposit. One of the oldest porphyry coppers probably in the world. And they're trying to advance. That project's been around for quite a long time. It's been explored by Rio Tinto and Teck, and these guys are trying to advance it. The biggest issue for them, it is a low grade. They're trying to build up the grade by including the credits like Molly into the resource, but also their big issues are infrastructure. So, to have such a big mine that you would have to mill it, you need a lot of power, and Namibia was a net importer of power. And so power becomes their big crux, as well as water. The amount of water they need, because we're talking about almost not quite the Namib Desert, but very dry conditions. Rivers close by, but how much water can you take? That sort of thing. Those will be issues that they will deal with. And so it's very infrastructurally related, given the grade, but also the infrastructure in that part of Namibia. But jurisdictionally, it's pretty good. I mean, you could drive there. You don't have security issues and stuff like that. So Namibia is definitely jurisdictionally an excellent place. Infrastructure, it's not easy. That's the issue. And then that you could take over into other parts of Africa, like the Central African Copper Belt, where, Zambia, the roads are much better than I remember. And also, built mostly by Chinese, big Chinese presence. You walk around the streets there, there's Chinese doctors just basically with signs in Chinese. It almost looks like West Vancouver. So, but then you have a juxtaposition of Western countries active there. You got First Quantum, Rio Tinto's active, Anglo-American. So a lot of activity there. The Indians with Vedanta, and they're also putting more money into it. So Barrick is expanding Lumwana, Concola. The Indians are looking to restart that. First Quantum over the last year, they've been expanding that after they lost Panama. That's basically their biggest growth. So Zambia is very much on everybody's radar because the DRC, although it's very prospective, the problem is that a lot of Western companies won't go there. So the DRC is more a place that the Chinese will go into, but the West won't. And if you take that Central African copper belt, it goes to the northwest and then it makes an arc and comes back to the southwest. That's going into western Zambia under the Kalahari sands and then into Angola. And some of that actually comes back into the northern part of Namibia. So that's a part that people are looking at as well.
So does that Chinese presence there, maybe the growth of Chinese companies moving in and developing projects there, does it shy you away from investing in some of these areas or in the country broadly?
No, for me, it brings another player in. As long as I have both people playing, both the East and the West playing, that means there's more potential suitors for the asset. If it's only the Chinese, that could be problematic. And and if it's only the West, that could be problematic as well. So you need a combination. You need a combination. And those places that allow both are the ones that interest me the most because then we have more players. And so the DRC is very interesting, but that would be probably more likely a Chinese only bid. Whereas Zambia, Namibia, you could have bids from both sides. And then also, then I have to look at the issue of Canadian listed company. So if I want to attract the Chinese bid in terms of an investment or something like that, I have to be open to it. It's got to be possible. And so what Solaris did might be what a lot of these companies need to do in this part of the world, where you do have a potential Chinese bid.
Yeah, it'll be interesting to see if more companies change their listing to other listing and other exchanges to get out of Canada just for
And
that
then
very
it's
reason.
not just listing. The listing is not the issue from what I'm understanding. It's the redomiciling of the management. That's the big deal. And then also, what you need to do when you redomicile is then you have to pay an export tax of some sort. And depending on the size of the company in that could be a significant draw on your treasury. But if you've got a private placement pending with Zijin, like Solaris, it makes sense to do it. But if you don't, then that becomes you're asking people to give you money just to basically be able to re-domicile, and you got to sort of explain it to them that then you can open up your access to capital. You're not going to sort of leave out one potential list of suitors.
Well, Joe, just when you think of Africa, a lot of people also think about the PGMs in South Africa, but Zimbabwe was busy. Tanzania put some onerous taxes on some companies, though, and Zimbabwe was a hot spot for a while. Any thoughts on those jurisdictions?
Oh, Zimbabwe hasn't been a hot spot for a long time. It's been a hot spot, but for the wrong reasons. Like I can tell you, like Zimbabwe is sort of like the Venezuela of South America. Now that Argentina's much better, is you know when you go and take an Uber in Cape Town, they're mostly Zimbabwe people that have been there for almost 10 years that have moved out of Zimbabwe. So Zimbabwe in the 90s, when I first went there in the early 90s, was a great spot. It's just gone down since. There are some mines there, but it's not a place that, people are, busting the door down to get to. That's definitely not where Zimbabwe is. Tanzania might be a little bit better. I'm not sure, but those aren't two jurisdictions that I'm overly focused on.
All right, Joe, let's talk a little bit about stuff that's been happening in your portfolio, what you've been sharing with your subscribers. You shared with us off mic that it's been copper plays, more copper exploration plays that have been benefiting the portfolio that you have. That, I guess, could be surprising to some people because, look, copper exploration plays have largely been, I think, ignored. What have you been seeing? What's been moving your portfolio?
So it's called exploration insight. So we tend to do more exploration development and less big gold companies. So those people that have owned the big gold companies, like your Agnicos and that, would have done very well. And I'm not denying that. And if I held them, I probably would have done very well on them. But that's really not what the letter's about. And so the leverage that I've gotten from the gold part of the portfolio is probably in line with everything else, but not outperforming everything else. So that the beta was provided by those companies, but the alpha was underpinned by companies that were, discovering new things in new jurisdictions. Like I'll give you one example was in Kazakhstan with Aris Minerals. I went there last September. I added that to the portfolio. That's that company's been drilling. They've been coming up with some good results. And so that has been one of the big outperformers this year in the portfolio. And then with, let's say, with Inflection Resources, that's going undercover in the Macquarie Belt in New South Wales. They drilled a hole. It's low grade. It's not economic, but it suggests that these are like blind holes going 300, sometimes 400 meters undercover before they hit the bedrock that, manage to hit something that looks very similar to what people are mining down the road at Cadia. So that was huge. So it was these grassroots plays where nobody's re-drilling a hole here. This is totally opening up a different area in places that make sense to develop. Like New South Wales, you've got some big underground mines there. And in Kazakhstan, there's some really big open pits there. Power is very inexpensive there. Infrastructure is pretty good, and the government is very open about foreign direct investment. So those are definitely those. So jurisdictionally, I'm very aware of where I want to be. And copper, more so than gold, requires a lot more infrastructure. And so that's one thing I do key in on.
Well, Joe, when we talk to a lot of people about copper, they tend to focus in some other jurisdictions, like for the Canadian side, British Columbia, in the U.S., in Arizona, and then in South America, a lot still in Peru. Do you like any of those jurisdictions or any companies operating in those areas?
Absolutely. So I don't have anything in British Columbia, but I did sit in on AMARC's discovery at their Aurora prospect there, and that was a great one. But that's the kind of grades you require for where they are because it is remote. So, what I'd be watching as well to see what like Centerra does with Chemes North because that's similar sort of grades, but that hasn't been put into production yet or restarted yet. So that's the thing I would watch as well. I would also look at like in terms of Peru, I do have an exploration play down there, which is also doing grassroots exploration. That one has been doing very well, even though they've taken a long time to get a drill permit, which they just got. That would be Hannon Metals on the eastern side of the Andes in a place that's not very well explored, looking for alkali copper gold porphyries. So yes, I am in Peru. And then in Arizona, we have Arizona Sonora. And I mean, that one has gone up this year, partly because with the Trump administration pushing for domestic production of minerals, this one would fit right into that thematic producing copper cathode. And then also they've got the investment, by Hud Bay Minerals, which is also developing a project, Copper World, down in Arizona. So, yeah, yes, I'm still big in Arizona and then in Peru as well. So, yeah, it's definitely multi-jurisdictional that I'm approaching the copper exploration and development theme.
All right, Joe, let's take a step to another area of the gold space and recap a lot of these earnings out of majors, mostly from this week. We continue to hear pretty much record revenues across the board, sometimes, a lot of the time, record earnings, free cash flow also at very high level. Production seems to be mostly in line with expectation and guidance. Newmont actually had much higher production, but then this year is guiding for a decrease in production. Barrick responded positively to their earnings. Newmont, bit of a mixed bag there. IAMGOLD, unfortunately, not responding very well to their earnings. It's been, again, kind of a mixed bag for earnings, but under that whole theme of record revenues, record cash flow, building up balance sheets. Joe, what's your takeaway from the earnings we've seen from the major gold companies so far?
So I haven't got into and dug into everybody's so far, but I did wake up really early to listen to Anglo Gold Ashanti's, and I'm very impressed by their free cash flow generation. So in 2023, in terms of free cash flow, this multi-billion-dollar company generated about only 109 million in free cash flow in 2023, and now they made about 942 million. So about, 9.5 times more free cash flow, or 9 times more free cash flow than they did the year before. So significant leverage. And if you look at the impact on free cash flow, it was mostly the gold price. I mean, their production was flat, which I think is probably a common theme for most of these producers. They're just basically leveraging off the gold price. And what they were saying is that in 2023, their inflation or cost inflation on average was about 8.4%. Okay. And usually we're looking at a CPI of 2.5 to 3. But in 2024, it was moderating down to 6.6. So they're still being impacted by cost escalation, but last year proved that, their margins expanded because the gold price went up at a faster rate than their costs.
Well, Joe, just from a market reaction standpoint, when I was watching the earnings come out for Agnico and Kinross, they both had a sell down afterwards. Now, Newmont and Barrick were already in the hurt locker a little bit, so they popped a little bit. Now they have sold off a little bit more since then, but some of the other companies haven't had the response people would have thought after all these record revenues and earnings and everything. Is there something that investors were hoping for or that analysts were hoping for that they're not seeing? Why are we not seeing more strength when we're at all-time highs in gold prices and the companies, maybe they're not perfect, but they're doing well. They're doing a lot better than they were a decade or two ago. So what is holding these companies back, I guess?
Well, I mean, I used to get this question a lot when I worked for Phelps Dodge at Newmont. When they would put out their earnings, they would go, well, why is our share price down? And it's those little statements you make about the future that everybody keys in on. Because, your earnings in that is talking about what had happened. And so that's mostly people upgrading their models in terms of what they had estimated and forecast versus what it ended up being. And most of them came in line, I would say. Some of them exceeded, but not by much. So most of the analyst targets, I would suspect, there was not a lot of big increases in target price post the release of the earnings. But then the expectations going forward would change their long term. And, once, some people go, yeah, we have pretty good production this year, but, next year we're not going to produce as much. Oh, we're going to start building this project and the costs have gone up on that. So those statements are what goes into your analyst model going forward. And that could be negative because if what you did was already embedded in the market, you're not going to get much, of a boost from that because they already expected that number. The problem is that when you start talking about the future and then it doesn't look as good as people think it should, that's why your share price might go down.
Yeah, all about that guidance. But Joe, make sense of this for me. Look, we all understand gold prices keep on moving higher. That moves the top line and even the bottom line for these companies. But look, they're not out there acquiring a bunch of assets. Yes, they're building some of their assets, which continue to cost more and more, but they're not also returning money to investors. Look, investors either want growth or they want income. It seems like these gold companies, the gold price is giving them growth, but from a company standpoint, these guys aren't delivering on growth from a production level or the income to investor level.
Okay, so there's a lot to unpack there, but let's start with the big companies. So the big companies, the bigger they get, the harder or probably impossible it is to grow. And Newmont's proved that. And all they're about is generating free cash flow now and sustaining dividends potentially and attracting a different investor class. But the problem is that most of these gold companies, their dividend policy is so unstable that it's harder for the investor that's looking outside that invests in a lot of things just for dividend yield and trying to translate, okay, here's this gold company. And then you're looking at their dividend policy versus these other guys and going, well, these guys, their dividend policy has been the same for 10 years. These guys change it, every year. That's probably not a good fit for me. What they are attracting is the investors that are potentially looking for gold exposure and thinking, well, I'll buy a gold equity ETF like the GDX or the GDXJ, but hey, Newmont offers dividends, and now it's big, it's liquid, it's diversified, and then it offers a dividend. So this is the one I should invest in over the GDX. But they're not probably getting those generalists that they're trying to get because their dividend policy is probably a lot more volatile than other people's. So that's a problem for them. They cannot grow anymore. And all they can do is run to standstill. If we go specifically on companies, Agnico has done a great job because jurisdictionally they've managed their portfolio really well, and they have this tendency that the market loves is that they meet guidance and they do exactly what they say that they're going to do. And so if you consistently do that, you get a premium. If you don't do it, you get discounted for several quarters. And this happened when I was with Newmont. You'll get discount for 3 or 4 quarters in advance just because they won't believe anything you say until you give them 3 or 4 quarters of meeting your guidance. So, and then with Barrick, another big company, your comment being in the hurt locker is jurisdictionally they're in places that people don't want to be. And before that was, you were able to like not talk about it and still make money like when it was Rand Gold. But now when you have problems in Mali and, your big investments right now are basically in Pakistan with Reko Diq, and then also now Zambia with the Lumwana expansion. So not everybody might be happy with that. And jurisdictionally, that risk is something people are embedding in your company. I would say in terms of growth, it's in the intermediates. They wouldn't be interested in a strong dividend policy because they're probably more interested in acquiring the next project. The M&A has been hindered by the overhang of the Newmont divestitures, which they divested almost like, was it $3.9 billion worth of, a lot of them producing assets, and people were waiting for that. Most of that is done. And so I should think that those guys willing to grow that didn't make it into the Newmont sweepstakes will be now looking at the next level of single asset producer, single asset developer, that sort of thing that makes sense for those guys. So I think most of the growth and the M&A at this stage will probably be in the intermediate and those guys that want to grow.
Makes sense. Those are the stocks that broadly have been outperforming the market too. They can grow, and they're also benefiting from this higher gold price. So very good comments there, Joe. It's always a pleasure having you on the show. Again, Joe Mazumdar, he is the editor of Exploration Insights. I'll post a link in the weekend show notes so all of you can learn more about Joe's letter. Everyone, thanks for tuning in to this weekend show. Please be sure to go back to our website, kereport.com. Check out our podcast on your podcast player by searching The KE Report, and visit our YouTube channel under The KE Report to keep up to date with all our daily editorials and the full weekend show. Joe, thanks again for your time, everyone. Thanks for tuning in. I hope you all have a great weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.